Hi, Randy Katz here. We're going to set the stage for discussing how companies are taxed in a business transaction. But before we do that, we need to lay a little groundwork on understanding different entity structures and different types of deal structures. So be sure to stay with us over the next few videos to be able to tie it all together. Have you given any thought to the type of entity you set up? I've spoken with a number of business owners who set up their company 20, 30, 40 years ago and haven't revisited a discussion about their entity structure with their CPA or corporate attorney since. The most common structures I see for businesses are LLCs, S-corporations, C-corporations, and to a much lesser extent these days, sole proprietors. There could be a number of reasons why one particular type of entity could make sense or be inappropriate for you. For example, an LLC has simpler corporate governance requirements than S-corporations or C-corporations, and flexibility in how earnings are paid out to various members of the LLC. But on the downside, all income is subject to self-employment tax, and they could be complex to form appropriately when you have multiple members. An S-corporation is like an LLC in that it's a flow-through entity taxed only once at the individual level. For many businesses, S-corporations have some tax benefits relative to LLCs due to the ability to avoid payroll tax on net income and due to the relatively new qualified business income deduction, which shields 20% of income from taxes for qualified companies. However, relative to LLCs, there's heavier compliance requirements. And additionally, the owner needs to be a W-2 employee, which might be more challenging for businesses that have lumpy income streams. When looking at C corporations, the most glaring difference is the double taxation of C corporations. Net income is taxed at the corporate tax rate, and then again at the individual tax rate once you take the cash out of the business. C corporations do allow flexibility and will be necessary for certain types of companies. For example, they allow the issuance of different classes of stock, unlimited shareholders, and the ability to issue stock options. The decision of which entity to choose really depends upon the growth trajectory of the company, how it's being capitalized, the level of profitability and how that profitability is being reinvested, who the potential buyer may be, and the owner's holding period. The entity structure not only impacts how a company may be taxed annually during the day-to-day operation, but can have dramatic impacts on how a company is taxed in the sale of the business. We're going to be talking more about that in the coming weeks, so again, stay with us.